Hi everybody, welcome back to the 10th of an Hour with Griffin Bridgers. For today's episode, episode 106, we're going to talk about the basics of Code Section 2037. So we've talked about 2036 and 2038 in prior episodes. Those relate, as you recall, to interests that maybe a donor or a grantor creates in trust, but maybe retains some right or power over that interest. But those bookend a little used code section 2037. And today we're going to talk about some of the basics without the calculations, mainly because this is such a misunderstood code section that it's hard to really kind of distinguish when it might be an issue and when it might apply. But as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, what Code Section 2037 does is it taxes certain reversionary interests in trusts or previously transferred property for estate tax purposes. Now, as I mentioned, there's many nuances to this which cause this code section to be misunderstood, because what we're going to find out is that this code section does not apply to every single reversionary interest under the sun. Now, what is a reversionary interest first and foremost? Well, it's any right that the grantor of a trust or the donor of a property interest that's transferred during life might ultimately retain to receive the property back in the future, maybe due to the passage of time or the occurrence or non-occurrence of an event. There's a variety of ways you can look at this. Now, a reversionary interest could really kind of be broken down in the estate planning world to one of two things. One, you could have the reversionary interest only be held by the grantor or donor only if they're living at the time. And if that's the case, that might be a reversionary interest that we're looking at under Code Section 2037. But if the reversionary interest can go to the grantor or the grantor's estate, then that is not covered by Code Section 2037. Instead, what we're going to see is that Code Section 2033 might cover that, or if there's a general power of appointment to the decedent's estate, that would be covered by Code Section 2041. So ultimately, to boil this down, what we're concerned with under Code Section 2037 are reversionary interests that did not happen. So once again, I want to reiterate this. 2037 only applies to reversionary interests that did not happen. So any reversion to the estate is not going to be covered by Code Section 2037 because that type of reversion did actually happen. Now, once you've drawn that distinction, we really have to get into the weeds here. And if you've been through law school and been in a property class, you might recall the headaches of walking through all those different permutations surrounding a plot of land called Blackacre, where you had to look at contingent remainder interest, contingent reversionary interest, so on and so forth. And if your eyes glassed over during those, you're not alone. I feel like that's the common refrain amongst many students, including myself. But we have to go back and kind of revisit some of those fact patterns, and I'm going to try to simplify these to the greatest extent I can. So we're going to have a trust arrangement where there's A, who's the grantor, B, as the current beneficiary immediately after the trust is created, and C, maybe as a remainder beneficiary down the road. So we're going to look at three examples which really draw some distinctions here. Now, first, we have an example where A created a trust for B, and at B's death, the trust is to revert back to A if A is then living. But if A is not living, the trust would go on to C. So the result is that the interest passing to C would be a reversionary interest that's covered by Code Section 2037, because the big nuance here is that the reversion can only relate to an interest in a trust that's obtained only by surviving the decedent. So that's one that doesn't happen, meeting our condition that we looked at, and it's one where there's no reversion to the decedent's estate. It's only to the decedent if living at the time. So that's why this first bullet point would be a reversion covered by 2037. Now, the distinction and where 2037 isn't going to apply is noted in the second bullet point here, where at B's death, the terms of the trust say that the trust will go to C. but if C is not living, the trust would then revert back to A or to A's estate. So that would not be a reversionary interest covered by 2037, but it probably would be covered by 2033, especially because the reversion is back to A's estate. Now, all of these are examples expressly set forth under the Treasury regulations for Code Section 2037. Then finally, at B's death, the trust goes to C, but if C is not living, the trust reverts to A, but if A is not living, the trust would go on to D. And in that case, the interest passing to D would be a reversionary interest covered by Code Section 2037. So, once we've crossed that hurdle, what interest is subject to inclusion in the gross estate? Well, it will be whatever interest goes on by virtue of surviving the decedent. So, whatever amount could have gone to the decedent, but instead goes on to somebody who survives the decedent, as a result of surviving the decedent, will be the interest in place. So it could apply to the entire trust, it could apply to a fractional interest in the trust, but either way, you figure out the value of that interest based on the decedent's date of death fair market value. And when we dig into this, there's also an actuarial possibility that creates a threshold. So if you figure out the actuarial value of the reversionary interest immediately before the decedent's death and divide that by the value of the trust, then if that amount is greater than 0.05 or 5%, then Code Section 2037 would apply. If not, you don't have to tax that reversionary interest. So if there's a wide disparity of ages, then it could be that you become or you get under this 5% testing threshold, and it's not a reversion you have to take into account. So in other words, the value of the reversion has to exceed 5% of the value of the trust. Now, this doesn't just have to apply to a beneficial interest. A reversion of the possession or enjoyment of the property is obvious, but this could also apply to a reversion of the power of disposition to the grantor or to the donor. So if instead of A becoming a beneficiary at B's death, instead we have a situation where A could become a trustee upon B's death, then we would tax this the same. Now, I also want to note that there is a carve-out under this section that says it does not apply to income-only interest. So going back to our examples, if A had had the right to the reversion of an income-only interest if A was living at the time of B's death, and if C's interest arose only by surviving A, this would not be covered by Code Section 2037. And similarly, if A could have regained the right to control the disposition, but only the disposition of the income and not the principal, that would not be covered by 2037 either. Now, as with Code Sections 2036 and 2038, there is a bona fide sale exception that you can take into account here. And then finally, there is one more difficult aspect to really grasp, but there's a carve-out and an exception for a general power of appointment. Now keep in mind, this is really going to apply to a general power of appointment held by somebody else, because if the decedent has a general power of appointment, under the ordering rules, we're looking to Code Section 2041 potentially. But if somebody else has a general power of appointment that was exercisable immediately prior to the decedent's death, then any interest that could have arisen through that general power of appointment won't be counted as a reversionary interest for purposes of 2037. So because you have to test this as being a general power that could be exercised immediately prior to the decedent's death, that would really limit this to a lifetime general power of appointment held by another beneficiary. So lots of nuances and lots of things to take into account with 2037. Luckily, it's not applied as often because trusts are often drafted in a way that prevents any property from ever coming back to the decedent, maybe if everybody dies in a common disaster under a remote contingent disposition clause, or at the expiration of the rule against perpetuities. Most of these issues have been drafted around, but it's still important to know how this works in the back of your mind. Now, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.